Good morning, everyone. Thank you for joining us for today's web presentation. We want to take a moment to express our appreciation to you for your support and to thank you for your interest in the services provided by VantageOne Financial. I'd like to start by letting you know that this is not a sales presentation. We are not offering today's hot stock tip or highlighting any investment product for that matter. We live in challenging and uncertain times made worse by misinformation, media hype, and social media trends. Today, you will hear an expert providing unbiased, research-based analysis of the markets and the economy. And I expect that you will gain some very valuable information, no matter what your current level of knowledge might be. If you have a question during the presentation, please click on the Q&A tab at the bottom of your screen. Type in your question and hit send. We hope to have some time at the end of today's session to address as many of your questions as possible. I've been assisted in setting up this event by our local Manulife representative, Mark Shimon. Mark lives right here in the Okanagan and provides our office with invaluable resources such as interaction with portfolio managers, advice on structuring complex accounts, and assistance with many of our day-to-day issues. Mark will be monitoring your questions as they come in and later moderating the Q&A session with Philip. Thank you, Mark. It's now my privilege to introduce our main speaker, Philip Petursson. Philip is the Chief Investment Strategist and Head of Capital Markets Research at Manulife Investments. Philip began his career over 25 years ago and has been with Manulife for more than 20 of those years. He has a degree in commerce from McMaster University in Hamilton and lives with his family in Toronto. Philip's responsibilities at Manulife include market and economic analysis, providing guidance and commentary to portfolio management teams, investment advisors, and their investors, and assisting the entire team with advice on development of investment strategy and asset allocation. Philip is interviewed regularly on BNN and has been quoted frequently in many of Canada's leading newspapers. We sincerely appreciate you taking your time from your schedule to be with us today, Philip. Thank you.
Thank you, Colin, and thank you everyone for joining today. Do appreciate the opportunity to speak to you. Sorry it's not in person, as much as I would love to be out in the Okanagan. And unfortunately, just we're all in the same conditions that where travel is much less frequent. I'm going to talk about a couple different things today in terms of how we should be viewing the market. And I think, Colin, you touched on it very, very well with respect to some of the headlines that could be a little bit more misleading to how we should be thinking about the economy and how we should be thinking about our investment portfolios. This is, I think, very, very crucial because this is how we avoid mistakes in our portfolios by remaining, I would say, even keel with the environment around us and where we're headed. So, Mark, if we could go to the first slide. The three areas that I'm going to be touching on today is one, really addressing the global economy and more importantly, focusing on those aspects of the global economy. In particular, I'm going to narrow in on the US economy as I think it is one of the leaders in terms of this recovery worldwide, what we should be focusing on as investors. When we talk about the economy, it includes a number of different areas, but not all those areas really are important to market performance, whether it be equities or fixed income. And so I really want to illustrate the areas that are of most importance to equity investors and fixed income investors and why it's perhaps better than we may think. The second thing I want to touch on is inflation and interest rates. We do believe that one of the byproducts of all of the monetary stimulus, or think of it in terms of the support that the Bank of Canada and the Federal Reserve of the United States has provided through this recovery, is going to be inflation. And we think that the fiscal stimulus out of Canada and forthcoming out of the United States is going to contribute to that inflation. And therefore, that's going to change the way that we should be thinking about interest rates over the coming couple of years. And then lastly, we've seen some seasonality in terms of market performance. We're going to continue to see more. And in fact, we've got an election coming up on November 3rd that is going to be very, very contentious, as it is already. And likely the results will be contested, as is being implied by President Trump. And so what should we be thinking about, and should we be doing anything at all in our portfolios as a result of that? So going to the first slide, or in the global economic recovery, let's look at unemployment in the United States. Now, one of the interesting areas that we've been drawing on for up to the minute information in terms of the US economy is Google Trends. And this is over on the left-hand side of this chart. It's quite interesting in that if you want to really get at the pulse of what people may be thinking about a particular topic, looking up the trend of the search trends in Google is a good way to do it. And what we can see over on the left is that in the search for how to file for unemployment in the United States, it reached its peak, or its most popular in terms of search activity, in March. Now, this makes sense, as March and April saw the bulk of the job losses in the United States. In fact, we saw 22 million jobs lost in the US as measured by the non-farm payrolls. But since then, you can see that the search for how to file for unemployment has really, really come down. And that's corresponded with improvements in the labor force that we can see over on the far right-hand side. So on the right-hand side, you can see the orange bars, that's the jobs lost in March and April of this past year. Again, in total, we had about 22 million jobs lost in the United States. But in the last 5 months, we've regained half of those lost jobs. Now, again, this is, I think, the perfect data point to ask that question: is the glass half full or half empty? Well, we've recovered half of the jobs that were lost in April. What that means is we haven't fully recovered in terms of the economic job losses from the COVID lockdowns. But in recovering half of these jobs, we've done something that, following the 2009 great financial crisis, the recession of 2009, where 8.5 million jobs were lost, we've recovered half in 5 months. It took almost 3 years to recover half of the jobs, half of the 8 million jobs lost in 2008 and 2009. The unemployment rate in the United States has fallen from 14.7%, a high that we haven't really seen since the Great Depression, to 7.9%, again, in 5 months. To get to 7.9% following the great financial crisis, where unemployment peaked at 10%, it took 35 months. So this recovery, while it might not be perfect, it's actually moving along at a pace that's much faster than what we would have thought, given historical precedent. Next slide, please. One of the other Google search trends that tells us that the US economy, and in fact, we can relate this to the Canadian economy, the US economy is doing better than what the headlines would suggest, is the search trend for buying a house. So in the United States, we've seen the greatest popularity, or the greatest searches for buying a house come in June, July, and August of this past summer, more so than we've seen in the last 5 years. Now, here's the point to this one. If people are looking for a home, if people are buying a home, getting into the housing market, they have confidence in their financial position. They have confidence in their job, and they can take on the liability of a mortgage. You're not doing this if you're fearful for your job. And we're not seeing this, or we wouldn't be seeing this, if the economy continued to weaken. So this really is a difference in economic growth in the United States. But the areas that are most important to me as an investment strategist are actually showing strength. I have a couple more examples that I'll just quickly go through, if we can go to the next slide, Mark. So here again, housing. So we talk about, what does the recovery look like? Is it a V-shaped recovery, meaning are we right back to levels that we were in January and February? With respect to housing, it looks like it has been a V-shaped recovery. It looks like we're pretty darn close to where we were in January and February this year. So this is housing starts on an annualized basis. You can see very clearly the drop in housing activity from the COVID lockdowns, again, March, April. But June, July, August, we've had a pretty good recovery back to levels almost where we were in January and February. So, we're seeing a very healthy recovery on the housing side. Next slide, please. On the durable goods new orders. So think about this in terms of durable goods. These are like washing machines, manufactured goods, really, if we think about it. Now, this is in absolute dollars. And so when you look at the left-hand side, for example, the current levels, right, sitting just below 240 million. And so what this tells us is that here too, we've seen almost a V-shaped recovery in durable goods new orders. So if we compare this to 2008 and 2009, it took years to get back to the prior level. It wasn't until 2012, in fact, that we were reaching the prior level of durable goods new orders. Here again, it's just taken a handful of months. So the recovery in key areas of the economic environment that are of utmost importance to the stock market are showing strength. Next slide, please. And lastly on this, I want to touch on retail sales, because this is, again, is another important one. If we look at retail sales here too, it's in absolute US dollars. If we look at 2008 and 2009, you can see the depths or the drop in retail sales and then the long recovery leading back to it. We didn't get a recovery in retail sales until late 2010, early 2011. Here too, very much like a V-shaped recovery. Retail sales not only are back to where they were in terms of the trend leading into the COVID lockdowns, but we've surpassed that, and we've seen retail sales increase. So we can talk about the unemployment level in the United States and the jobs that have yet to be regained, but we should also be focusing on the 90% plus of Americans in the labor force that still have a job. And that's important to us. As long as we continue to see some improvement, we're advancing. Second thing is inflation. So while we've seen what we would classify as unprecedented stimulus out of the Federal Reserve, out of the Bank of Canada, the European Central Bank, and there are consequences to this, we would say it was necessary. Now, first, just to illustrate the degree to which the Federal Reserve and Bank of Canada stepped in to provide, we say, liquidity to the markets. Basically, they provided cash where cash was needed. We can measure this in terms of money supply growth. Now, M2 is the technical term for how we measure it. Think of it as coins and cash in circulation. It's what we have in the bank in terms of savings deposits and checking deposits, money market funds, and so on. Normally, the money supply would grow with the economy. As the economy grows, if the economy grew by 5%, then the money supply would grow by 5%, and so on. Over the very long period of time, money supply growth and the economy, our economic growth, are the same. They tend to just match each other. What we've seen this year as a result of the support needed to keep the economy going, to fill that economic gap during the COVID lockdown, was unprecedented monetary stimulus by the Federal Reserve, Bank of Canada, and a little less so by the ECB and Bank of Japan. But in the United States in particular, we've seen the money supply increase by almost 25%. That has resulted in a weaker US dollar since its highs on March, and we think it will continue to result in a weaker US dollar going forward, which can help drive some inflation. So our inflation model is the next one, Mark, if we can go to that. Oh, sorry. Leading into that, before we get to our inflation model, leading into that, what we tend to see over time, which will be a contributor to inflation, is commodity prices tend to move in opposite direction of the US dollar. So here we have it shown where commodity prices on the right-hand side are inverted. And so as the green line goes up, and I apologize, it's not oil prices on the left-hand side, it's actually the US dollar index. As the US dollar index moves up, commodity prices tend to move down. As the US dollar moves down, commodity prices tend to move up. So this is why, if you've wondered why gold prices are over $1,900 an ounce today from $1,400 where we were in March, it's because of weakness in the US dollar that came as a result of an increase in the money supply. And we think this is going to continue. Remember, the Federal Reserve wants to see inflation. So they want to see commodity prices move higher. And one way to get commodity prices higher is to weaken the US dollar. Next slide, Mark. So we can track or we can forecast where we think inflation is going to go using a couple of key inputs. Now, what first thing I would say is the dotted line that you see here is our inflation forecast. The orange line is inflation as it comes in as reported on a year-over-year basis. Over on the right-hand side, it looks like we're suggesting inflation will be between 5 and 6% by the middle of next year. We would caution anyone in taking this and assuming that we're actually going to see that. Our model is very good at predicting the trend in inflation, higher or lower, not the absolute level. So I don't believe that we're actually going to see inflation at these levels. I do think, though, that we can see inflation between 2 and 3% into next year. Now, what that is going to do is actually push longer-term interest rates higher. So we're going to see long-term interest rates move up, which is usually a negative for long-duration bonds or long-maturity bonds. These are 10-year Government of Canada bonds, 10-year US Treasuries, anything that is interest rate sensitive, we think is going to be prone to weakness into 2021 in a rising rate environment. Now, while the Federal Reserve and the Bank of Canada have committed to keeping short-term interest rates at zero or close to zero in the context of Canada, we believe they're going to allow longer-term interest rates to move up, and they tend to be more market-driven. And so again, as inflation moves up, we tend to see interest rates move up, and this is what we think is going to happen over the course of the next year. So GIC rates or say at 5 years or less are going to remain less than 1%. But longer term bonds, as interest rates move up, they're actually probably going to lose money over the course of the next year. So it means that from a fixed income perspective, what our managers are doing are focusing on other areas of bonds that are less sensitive to interest rate movements. These are corporate bonds that have actually fared quite well through the equity bear market and offer attractive yields, much more so than what we can see out of government bonds. Next slide, Mark. If we could advance to the next slide, please. There we go. So now let's talk about seasonality. Let's go one forward. We saw some volatility in September. If we can go to the next slide. We saw some volatility in September. We saw the equity markets down in the United States just over 3% for the month of September. Now, what we would say is this is actually quite normal. There are a number of reasons for the volatility. We saw a little bit of technology selling off. We saw some volatility perhaps as a result of the US election that's coming up. And again, this is quite normal. When we look at the average return by month for the S&P 500 going back to 1950, September is the worst in terms of median return as well as average return. So if we were to expect volatility, September is as close to a sure thing as you can get. 52% of the time, September delivers a negative return, which is the worst of any month of the year. But we're also heading into an election year. So if we can advance to the next slide, October in front of an election year actually tends to be the worst. September is still bad, delivering an average negative return from 1952 and then every 4 years thereafter. But October is the worst year. Worst month of the year. Now, we think that this October can continue to see some volatility as well. Just in the last couple of days, we've seen volatility with respect to President Trump and being moved to Walter Reed Medical Facility and then back to the White House and all the tweets that came out yesterday and so on. We think this can continue to create some volatility. But in the context of the election, and if we go to the next slide, in the context of the election, we would say, do not allow your political views one way or another to translate into a market view. And I've been working on this, working against this for years. I've been in this business over 25 years. Every 4 years it comes up. What do we think about the election and what it means for the markets? And people can be rather disappointed in my viewpoint where I say it really doesn't matter. But history would support that. We've looked at the makeup of government in terms of the party controlling the White House, Congress, and the Senate, all the different permutations of it, and then the market results that follow going back to 1945. And our results show that on average, the markets are up. It does, our work would imply that Democrats enjoy better market returns than Republicans. We don't know why, right? That's just, we think it could be more timing than anything else, luck of the draw than anything else. Republicans do tend to suffer more recessions than Democrats do, and recessions bring about bear markets. So that could be part of the reason. But more to the point is when you look at both the left-hand and right-hand chart, you can see, regardless of the makeup of government, markets are up. In some periods, they can be up more than others, but the markets are up over these periods of time. So to try and glean some type of an edge with respect to the market performance based on who's going to win the election is really an exercise in futility. We really don't think it matters. Good companies find a way to succeed in any environment. And so, not that I'm a full believer that if Biden wins, he's going to raise taxes right away. I don't think that's going to happen. I certainly don't think that would happen in the context of a still recovering economy. At the same time, I wouldn't necessarily say Trump is overly good for the market. I'm benign, I'm indifferent to it, because what I've learned out of history is it really doesn't matter. And so while I embrace political passions and viewpoints, and I encourage that, don't allow that to translate into some view on the markets based on an outcome, because it doesn't tend to happen that way. So, let me just wrap it up here and just say that the three things that we're focused on right now is, where are the sources of earnings growth or recovery that are important to the market? And are these showing strength? And they are. We're seeing this in terms of, again, housing, the retail sector. We're seeing it in terms of manufacturing in the United States. These are all positives. Inflation is something we should consider going forward, because it will shift our thinking of fixed income investments over the course of the next couple of years. We're already doing that in our portfolios. And then lastly, seasonality. Yes, we can expect some volatility. We would suggest, given the first two, embrace it. Given the fact that we believe the recession is over, that we are now in a new economic expansion, if we were to see a correction in the marketplace, if we were to see a bit of a sell-off, we would embrace it. We would take that as an opportunity to rebalance into equities, or even increase equities if we have capital available to us, to take advantage of that market volatility that historically, absent a recession, has rewarded investors 12 months out. So Mark and Colin, I'll pause there. Happy to address any questions that have come in or you may have.
Thank you very much, Philip. Yes, Colin, if you do have any questions, please feel free to chime in, but I do have a couple here for you, Philip. You talk about inflation and interest rates being quite low, and GIC rates not being the best place to get a lot of yield. Would you have any suggestions where people can maybe reallocate capital in order to get some yield that they might need to satisfy long-term growth or just income needs?
Well, absolutely. There's two areas that I think continue to be attractive for us. One, on the fixed income side. So if we think about bonds, how do I generate a better return than what governments are offering? It's corporate bonds. Corporate bonds, whether it be investment grade or high yield, are offering anywhere between 3 and 10 times what government bonds are offering. And given the support by the Federal Reserve, we think that the credit risk or default risk is low, much lower than where we were, say, 10 years ago. So that's one area. But the other area continues to be dividends. We continue to see companies offering very attractive dividend yields in Canada and in the United States. Well, in Canada in particular, with the dividend tax credit, you can look at the banks, for example, where you're enjoying dividends between 5 and 6%. That while they might not grow in the next year or two, I think that it's very unlikely that we're going to see a dividend cut out of the banks over the next couple of years. These are well-run businesses, well-diversified businesses with yields that, relative to the Canadian 10-year government bond, 10 times what you can get there. And so there are other attractive areas. Yes, you have some equity risk, but I have some implied security in that income.
Thanks, Philip. Appreciate that one. And like you talked a lot about volatility, and there was a V-shaped recovery in the economy, and the market looked like it came back quite substantially. But volatility is here. Going into October, you mentioned you showed a slide of volatility. What are your thoughts on dollar cost averaging? And are there times better to do dollar cost averaging, or are there times better to not do dollar cost averaging?
So, well, I think always is a good time to do dollar cost averaging. I think it helps smooth out our investment returns. And what we've seen over time is that, dollar cost averaging, because it's like a systematic program, it tends to keep people invested. So it helps us avoid mistakes of trying to time the market. What we've been saying over the last 6 months is we felt that this market was perfect for dollar cost averaging. Now the recovery did come a lot faster than we thought, but we do think that dollar cost averaging even today is still worthwhile with a view over the course of the next 6 to 12 months. That said, if when we do see corrections of 10 to 15%, it has been to our advantage to accelerate that dollar cost averaging program, to buy more when the markets are down 10 to 15%. Again, when we're not in a recessionary environment and the markets are down 10%, they tend to be positive 1 year forward 90% of the time. And so those are good probabilities and worth taking advantage of. So now I should just say we are seeing a V-shaped recovery in segments of the economy. Some people are describing it as a K-shaped recovery because some areas are doing really well, some areas not so much. What I am focusing on, what matters to the market, looks more like a V than a K.
Philip, we've had such low interest rates recently, and you expect that that's going to continue. People that have been dependent upon their income from interest are really disappointed with the fraction of a percent now for their GICs. How long do you expect that we're going to have these ultra low interest rates?
It would appear that the Bank of Canada and the Federal Reserve are committing to keeping interest rates low through 2023. So I would say, 2 years, very likely, potentially 3. They can always change their mind, but they seem to have implied that 2023 is when they will consider starting to raise rates. So we're looking at 2 to 3 years of very low interest rates for GIC returns. Now, you go out, longer term bonds or say longer term GICs, past 5 years. To be honest with you, I don't even know if they offer them past 5 years, but right now they don't look very attractive. They might look more attractive in 3 years' time, but between now and then, very, very lackluster prospects for interest rates. And I think what this is going to force investors to do is be less reliant on bonds for income and perhaps more reliant on equities for income. That doesn't mean that just hope that stocks go up. It means back to that kind of dividends. I can build a better retirement income by incorporating dividends into our portfolios.
Thank you.
Thanks. And I'll one more, Philip, before I close. And this is a conversation. I think it can be at the kitchen table. It can be all over the place now. But growth and value, I know, is a theme that people talk about. Are you a growth investor? Are you a value investor? And I know you've had some great comments recently about sort of the merging of those two thoughts. Could you just give me your comments on nowadays? Is it a growth environment? Is it a value environment? Or is it somewhat of a combination of the two, and maybe why?
That's a great question, Mark. And it really depends on your definition of growth versus value. I would say the traditional way of looking at growth versus value is you take the market, you draw a line kind of down the middle of it in terms of valuation, and you say all these companies that are left of this line that are cheaper valuation. So the bottom half of the market that's cheap, those are value. The top half of the market that's expensive, those are growth. I don't think that that's a great way to look at it, because then you're sitting there saying, well, I can't have companies that are attractively valued relative to their growth rate. You can, and we've seen a number of them. So I think the traditional sense of value versus growth perhaps is a little flawed. And when I look at our managers, those that would have been described as value historically, they're sitting there saying, oh, I still want to buy good companies at reasonable prices, but I'm not going to ignore companies that are growing at a fantastic rate. And I'm, at levels that look a little bit more expensive than the historical norm, because they're also growing much faster than the historical norm, and therefore you're being compensated for it. So it's not, we're not changing the way we look at things. We're just saying, look, I'm very comfortable owning companies that are growing and paying the right price for them. It doesn't mean I just have to buy cheap companies all the time. So we can get locked into this. And the other interesting aspect to it is that maybe we're looking at these companies wrong, in that a lot of technology companies don't have a lot of hard assets. So it's hard to buy undervalued assets when their assets are intellectual property. And it's difficult to attach a measure to that. So what we try and do is really look for good companies with low leverage, meaning low debt, that are well run, have some type of competitive advantage, and are growing, right? And they're growing over time. And then just pay a reasonable price for that. But to try and say, is that company a growth company or value company? I would say the answer is yes. It's both in a way.
Thank you, Philip. I'll let Mark close off in a second here, but I just wanted to say it's great to have your expertise and the research resources of Manulife available to us, helping us in our investment decisions. So thanks very much for being with us today.
My pleasure. Thank you.
Yeah, thanks a lot, Philip. I really appreciate it. And for those that are on the call, Philip he's been on BNN numerous times and quoted, as Colin mentioned at the beginning, in a lot of publications in Canada. You can ask your advisor, so to ask VantageOne if you would like some more information from Philip, and there'll always be some client-friendly material that Philip will present to talk about the current market environment at that time. Or if you are a podcast goer, you can look at Investments Unplugged. That's Philip's podcast, which I find extremely informative if you'd like to hear from him on an ongoing basis. So the flow of information from Manulife Investment Management, their chief investment strategist, will always be there for you. So again, thank you very much, Philip. I really appreciate you taking the time. And Colin and VantageOne, thank you very much for having Manulife. We're very happy to be a partner with you. Those on the call, the value of advice is extremely important. The value advice is more important than the actual price, I like to say. And there are numerous studies, whether it's Dalbar's study or whether it's the Serrano study, that is saying that investors are far better off dealing with a financial advisor over their lifetime than without. The change that they have in their wealth is dramatic, and there's a lot of other aspects out there that financial advisors can help you out with. And I've been in the business about 22 years, it'll be this February, and I've worked with a lot of financial advisors in my time, and the people at VantageOne, in my opinion, are just such quality, very credible people to deal with. So you're lucky dealing with them, and so am I now moving out to Kelowna and dealing with them. So thank you very much, Colin. I really appreciate you taking the time and having us work with you. And
thanks again, Mark and Philip, and thank you everyone for participating today. Have a great day, everybody.